Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab. And if you are new to the world of options or intimidated about what options are all about, know that you are in exactly the right place. Because with an option strategy, and over 12 weeks, we're going to talk about 10 different strategies. There are strategies that are designed to work when the market is going up. There are strategies that are designed to work when the market's going sideways. And then there are strategies that can be profitable when the market is going down. And so when I was introduced to this education back in 2011, that fascinated me. Now, are there risks with options? Of course there are. And we're going to talk about what those risks can be. But today what we're talking about is strategy called cash secured puts. And so if you have no clue as to what that is, you're in exactly the right place. We are in week 6 of a 12-week rotation, but I'm assuming that you know nothing. So, and if some people I know are going through this rotation for the 5th or the 6th or the 7th time, and I applaud you for that. But if you're showing up here for the very first time, feel free to type a greeting into the chat so that we can welcome you. We get together here every Tuesday at high noon and we link arms together and we are figuring this stuff out. I want to thank Priya and Rob and all the rest of you who are here with us live in the chat. Sandeep and Jay and Backroad Bob. There are some great handles here, and Kevin and Paul. And we also have Scott Thompson, who's a former coach, now one of the leaders in our organization, and he is riding shotgun in the chat. I've learned a tremendous amount from Scott over the years. So if you have any questions, don't hesitate to ask. If you've got questions and you're watching this in the archives, you can type them in below. Consider this an invitation to follow us in the land of X if you are not doing so. My handle at Barb Armstrong CS and Scott's at Scott Thompson CS. So know that as we roll into this topic today, that options carry a high level of risk and aren't suitable for all investors. If you want to try trade options with Schwab, you have to apply for option trading privileges, and not all will qualify. We've got to take transaction costs into account. With the cash secured put strategy, we could end up having to buy the stock, at a price that is higher than where the stock is currently trading. And we'll get into those details. We use the thinkorswim paperMoney platform in this class. And it's a brilliant place to figure out what you're doing and to be able to place example trades, to become familiar with the platform, to make sure you understand your trading strategy and how it works, both if it goes for you and against you, before you consider trading in your live account. One of the nuances or differences, though, between paperMoney and a live account is that a short option will never be assigned early. And if you don't know what that means, don't worry about it. We'll talk about it as we go through. But in paperMoney, short options will never be assigned early. So we don't get to practice that in paperMoney, but we can discuss it. In your live account, that can happen. Okay? So know that all investing involves risk. What we're talking about today is cash secured put. So if you're not familiar with that strategy, we're going to talk about what it is, why you might find it of interest. We're going to cover some of the basic considerations in selling puts. We're going to do an example trade, and then we're going to talk about what you might want to do next. Now, I'm going to kick it off with a quick announcement, and that is that in addition to doing webcasts like this, we also have some live in-person events. The next one is in Anaheim on September 13th at the Anaheim Marriott. It is a one-day market drive event, and I will be at that event. If you'd like to join me, please come up and introduce yourself. I'd love to meet you. And then that's followed by September 27th and 28th in Miami. There's a whole, if you go to the schwab.com/events, you can see everything scheduled out to the end of the year. Okay, so back to our regular programming. So cash secured puts, what is it? Well, first of all, it's a contract. So we're entering a contract. And so contract, what does that mean? Well, what that means is we are creating an obligation to buy the stock at the strike price that we have chosen at any time up until the expiration date. Now, when I read that, it's kind of hard to wrap your head around. So we're going to kind of draw it out. But it means, when we see, cash secured, what does that mean? It means that your broker is going to take, if you've agreed to buy a stock at $50 a share, each option represents 100 shares of the stock. So it's going to say you've agreed to buy 100 shares of stock at $50 a share. So we're going to take $5,000 and set it aside just in case you end up having this stock put to you and end up buying it. So they're going to put aside enough money to cover your buying the stock if it's assigned. So this is a bullish strategy because you could end up owning the stock. And if you're saying like, I never want to own Tesla, then don't sell a put on Tesla because you could end up owning it. And I'm not trying to pick on Tesla. I'm just, picking something random. Okay. So, why do I have a blank slide in here? Because for me, I kind of have to see things for them to make sense. So I'm assuming that there may be one or two other people that kind of feel the same way. So here we have a stock, and let's just say the stock's been uptrending. So it's going up and then it pulls back for a few days, as stocks sometimes do. This is called a bull flag pattern. And then it starts to go up again, and then it maybe pulls back a little, and then it starts to go up again. And you're looking at it and you're going, hey, this looks like a trend continuation pattern. I think this baby is going to continue to go up. And I'd like to make some money. And there's a couple of reasons people will sell puts. One reason is that they just want to make some cash, either for income or to grow their account. So they might say, I think this is going to continue to go up. So I am going to sell a put below where I think it's going to go. So I'm going to sell this put at $50. And maybe the stock is currently trading at, say, $52. And maybe you get paid, and I'm just picking a number out of the air here, you get paid $2. $2 a share, and then it's times 100 shares. So you get paid $200. Now, what do we want to happen? Well, we want the stock to continue to go up. And if that in fact happens, what happens to the value of the put? Well, the value of the put, as the stock goes up, it becomes worth less and eventually becomes worth nothing or worthless, which is exactly what makes our day, because we are selling this to open. And now, do we want to wait till it goes to zero? But let's say it's now worth 20 cents and we've got 90% of our max gain. We might just say, hey, you know what? I've got 90% of my max gain here, so I'm going to buy it back. Or I've got 80% of my max gain, so I'm going to buy it back and take my risk off the table. Because what is the risk? I'm glad you asked. Well, what if it comes back down and then maybe comes up again and then goes below our strike? Now, as long as it doesn't go below 48, if the stock is put to us or assigned to us and we have to buy it, this is our break even because we got paid $2. So, if the stock gets put to us, and if it's in the money at expiration, we will end up the happy or proud owners of 100 shares of this stock. At 48? No. We've agreed when we sell this put, we've said, hey, if you'd like us to buy 100 shares of this stock at $50, we're happy to do that. And you can't, if it's assigned, kind of go, hey, JK, didn't really mean it. You are obligated. Now if it continues to go down, and here's the risk, what if bad news comes out and instead of going up as we expected, let's say the next morning it gaps down and then keeps on going? And now it's sitting at 40. Well, you've agreed to buy it at 50. So now like you're a hurting unit. So there is much sadness in the land, and this is the risk. And I mean, the ultimate risk is that it could go to zero. Now, is it likely to go to zero? Probably not. But if that happened, how much would you be out by? You'd be out by this strike, $50 minus what you got paid to get into the trade. And the other thing is that the most you can make is what you receive when you sell this. Okay. Are there any questions? So we're bullish on this. This is a bullish strategy. Okay. Now, the other reason someone might sell a put is because they'd like to buy the shares. They want to buy the shares. And then why not have somebody pay you to buy stocks that you wanted to buy anyway? In which case you might not have sold the put at 50. You might say, if you wanted to buy the stock, you might say, I'm going to sell a put at 52. And, because I'm hoping to have the stock put to me. I seldom use this strategy as a stock acquisition strategy on purpose. Why? Because I was always afraid that if it came up and then it took off, like I'm going to get paid more if I'm selling a higher strike. So now maybe I get paid $3, but that if the stock goes up by $5 a share, I would have been up by $5 instead of the $3 that I got paid. So, I would have that fear that it was going up and not going to take me with it. And so for that reason, some people hesitate to use the strategy, but they might say, hey, you know what? Like I still made money. So that kind of beats a poke in the eye with a sharp stick, right? Like hard to complain. But if you're seeing this as being a stock that's going to continue to uptrend and you see in your mind's eye, or your belief is that this stock is going to continue to go up and you don't want to miss getting on the boat, then you may just want to buy the stock and not sell the put. Okay, so we're going to move along. There is a class taught on Mondays by Mike Fairborn that just talks about selling puts or short puts and then covered calls. So if this strategy is appealing to you, you may want to check out that class on Mondays. Now, I believe in trading plans, as many people do, and there are 4 components: what to buy, when to buy, how much to buy, and then when to sell. And so this is our kind of what to buy and when to buy components of an example trading plan. And so in our what to buy, well, we're looking for a stock that is uptrending. And some might also say, I'd like the market to be uptrending, and I'd like the sector that the stock is in to be uptrending also. So you want the stock to be uptrending, the sector it's in to be uptrending, and the market in general to be uptrending. And there are some people that even create checklists, I don't know who would do that. They're looking for also stocks with higher trading volumes. And how do you define that? Well, you might say, I want it to trade 1 million shares a day plus. You can make the number whatever you want. I've seen James use 5 million. And then you want the options to be heavily traded. And, the odds are if the stock is heavily traded, it's more likely that the options will have higher trading volumes. And open interest is the number of contracts that were on the books when the market opened today. Volume is the number of contracts traded today. And so you might say, I want this to be 10 times or 20 times the number of contracts I'm looking to sell. And why do we care about that? Because we want liquidity. Like when we go to buy that back, we want there to be someone who wants to buy it back from us. And other people I've seen, they don't even have this as, up on their option chain when they look at their options. They're just saying, as long as the bid-ask spread is tight, and the difference between the bid and the ask is what the market maker makes, And so if you're saying, I don't want to give him any more than I have to, so you might say, well, I want this to for sure be less than 10%, and I'd prefer it to be pennies apart. But the market maker tends to be willing to take less if it's really easy to match people up and there's a lot of volume. So these are some things. And then on when to buy, we're looking for a bullish entry. And there are whole classes dedicated to technical analysis. But one of the ones that I drew, this is called, a bull flag. And you've got, so you've got something uptrending, and it might be bouncing off a moving average. So, it's bouncing off a support area, and you're looking for a close above the high of the low day. We might also consider it to be bullish if something's been going sideways, and that could be a bounce off a support area, or if it breaks through a ceiling. So these aren't all of the ways, these are just some examples that we're looking for, a bullish entry. So let's go out and look at the thinkorswim platform and look at a potential example, because I know for me, this was kind of what brought things to life. And so I brought up American Express. Now, American Express is up 36.8% year to date. So is that uptrending? It's uptrending. You say, well, American Express, you talked about, sector. What sector is that in? Well, if we come to the Analyze tab, we can see that it's part of the financial sector. And so you may want to do some fundamentals, look at some of the fundamentals. And on the Analyze tab, there is a fundamental tab, and you can come down and look at a lot of this information, because you could end up owning the stock, right? But if we say, well, we've looked at that because we just want to see what the sector is, and then we can come over here and say, well, how is the financial sector doing? Well, it has hit a new all-time high today. So it's doing pretty well. And this sector is up 21% year to date. So it's a strong sector. Well, how about the market in general? So if we came and we brought up the S&P 500, which some would say represents the market, well, here's the all-time high for this index. And how close are we to that? Well, we're within, probably 2%, 1.7% of the all-time high. And although we had a pullback, it's been uptrending. Remember that bull flag pattern? We kind of have that going on here. And even though it's pulling back today, overall, this index is up 17% year to date. So uptrend in the market, in the sector, and then we come and we look at American Express and we say, and the stock is uptrending as well. So that's check, check, check. So then the next thing on the list was, does this trade 1 million shares a day or more? Well, we've already got 1 million shares traded today. And if it's sitting at 256, we might say, hey, remember that sideways pattern? It kind of went sideways for a bit, and then it broke out and came back and retested. What if we sold something around 250 or below? So if we come to our trade tab and we say, okay, if we're looking for something in that neighborhood of 250, first of all, has it traded 1 million shares? Yes. If we come down and if we're looking for something in kind of the, maybe 20 to 50 day time frame, this number here that's in brackets says October 18th is 45 days to expiration. This 100 tells us that each contract represents 100 shares. So if we look at this 250, when we look at open interest, do we have 20 times? And we'd only do one contract. The number of contracts, we've got 1,300. We have 26 that were traded today. And, do we have a tight bid-ask spread? Is it less than 10%? Well, on a $6 option, you'd want it to be less than 60 cents, and we have 15 cents. So it's like check, check, check. And then the next question is, are we getting enough premium for this to be worth our while? And if you say, well, that's $610, and what is that as a percentage? So we could come over, let me close this, and I'm going to switch this to a calculator and say, well, as a percentage, if we looked at $6, let's just take it as 6, divided by 250, which is the strike, that's 2.4%. Yeah. Andy's saying it's not 1% per day. Well, yeah, we're looking, that's a whole different trading strategy, but I'm glad you remembered that. So if we look at this and say, well, what would our break even be? Well, it would be that we're agreeing to buy the stock at 250. And would we be sad if we ended up with this in our portfolio? You know, we might say, yeah, it's a good stock. I would be okay with that. And then my break even would be, as long as it doesn't fall below like 244, then I'm ahead of the game. And if the stock continues to go up, as we're expecting it to do from a technical analysis perspective, if you say, well, I'm thinking it's going to go up, and then what happens then? Well, you get to keep the $6 and you haven't bought the stock, or the $600. Now, what if it goes sideways? Well, you still get to keep the credit and you don't end up buying the stock. So this way you're happy. This way we're happy. Now, what if it goes down to, say, 251? As long as it stays above 250, the odds of it being assigned is low. But if it goes down to, say, 248 and you're assigned, what could you do? Well, you could turn around. You've had to pay 250 for it, but once it goes into your account, you could sell it for 248 and you're still ahead of the game by $4 a share. Now, where are you losing is if it goes below 244. Or sorry, yeah, 244. So let's say it did that, and I'm just going to wipe the slate clean. What if it came down here and you end up being assigned, and then it bounces back up and ends up, going up? Well, in the short term, you could be down, but in the longer term, up. But you have to be able to afford to buy $25,000 worth of stock. And then, another question you might have is, for this account size, is that appropriate? Because this is almost an $800,000 account. And so if you said, well, I don't want any one position to be bigger than 5% of my account. So if you took 794,000 times 5%, we could have a position size of almost 40,000. So is 25,000 less than that? It is. So are we okay with that? We are. So we are going to come out here to October. We're going to look at this 250 strike, and we're going to say we would like to sell this. And we're going to sell custom with a stop. Actually, we're just going to sell. I'm just going to put this in as selling a single. And then we're going to come to single order, first trigger sequence, right click, create an opposite order. And you might say, well, my rule when I trade these is when I have 90% of my max gain or 80% of my max gain, I'd like to buy it back. But I don't want to buy it back until I've got that. So if you said, okay, I want to buy it back when I've got 90% of my max gain, just as an example, you could say, well, what is $6.10 times 0.1? Well, I want to buy it back when it's worth 61 cents. So you just come in, say, hey, when this is worth 61 cents, buy it back. Now, what if you're looking at it and the stock has gone up really nicely and you're up 85%. But it looks like the stock is going to come back down. You might say, hey, you know what? I've got 85%. I'm going to go in and change this exit. Is that breaking your rule? No, that's just managing the trade appropriately. But, you could be out golfing or walking your dog or, doing whatever, grocery shopping. And if this stock were to move up nicely, you could end up out of it and come back and see that you had locked in that gain. So we're going to put this in our short put group. Okay. Now, my buying power will be below zero. It says I've got 50,000. Oh, you know what? Let me just see. Buy single. This is one. That should work just fine. Now the value's going up. Read opposite order. You want to buy it back. It's one. It's in. I just want to make sure I've got it in the, that's 37. Okay. This doesn't go in, there's something glitchy with the system. And there we go. Okay. So, and I'll make sure. Now you could do an OCO bracket. So somebody's saying, can you do an OCO bracket with a stop? You could, but what you may want to do is just monitor this and decide, like if it comes down here, you've got 45 days. So in 45 days, could it come down here and come back up? Now you could be assigned at any time, if it comes down below here. But when we look at when this came down before, how long did that take? 3 days. It came down and it was in the money, and then it came back up, and now it's broken above. And so when it comes to short puts, some traders will say, I'm going to put in a target. Oh, did I buy it? Okay, let's go in. Sorry, guys. Apparently, I bought this put. Filled order. Oh, I opened and closed it. I bought it. Okay. So you know what? Here's human error at its finest. So I bought it and sold it. It cost us $5 plus our transaction fees. Let's go in and do that again. So we're going to come in and we're going to sell our put. We want to sell it. And then we're going to come to single order, first trigger sequence, create an opposite order. And make this 62 cents. So you can see when you're live in the market, the prices can fluctuate throughout the day. So we're selling this to open and making this our short, putting it in our short put group. Okay. There we go. Okay, so there's something weird happening with this account. Now, one of the ways, if you're in paperMoney, one of the things that we could do is come here and we could just add more cash to the group and adjust the cash. Now, we wish we could do this so easily, right? In a live account, which is not quite that easy. But if I wanted, I could say, I just want to make this $1 million account. And so I'm going to add that. Hit OK. And then we're going to come back and we can put that in. And so, in your paperMoney account, you have that kind of latitude. In a live account, you don't. And I don't want to spend, more time on this one. But if you wanted to practice, are there some other stocks that you could look at? Well, we could look at Southern, which is a utility stock, which is kind of breaking out to the upside. And could we look at selling a put maybe below, if we were doing this as a way of generating income, could we do that below here? Could we look at an IBM? Which had this big, this is called a cup and handle pattern. So, and I've posted, if you're not following me on X, you're missing these, but I will post just pictures with these kinds of patterns, and then it broke out. And so could we sell a put at this, 197 or below? And you might say, well, this candle pattern might be indicating it might be pulling back for a few days. So you may want to see if it comes back and then bounces. So that might be, another example you could look at. Or Chubb. We look at CB. And again, do you see what I see? That same kind of cup and handle consolidating pattern, yet it's still, up 27% year to date in the financial space, broke out. So could we sell something and get enough premium for that to be interesting? Well, it just might be another example. Okay. Yeah, like, so somebody's saying, Eddie, one of the alternatives is to sell something and then you can add your exit in later. Yeah. And that's absolutely something that you can do. So if we went in, if you want to see how you would do that, just let me come to this. So if we come here to the trade tab and we look at this, oh, this is Chubb. We wanted American Express as our example. So if we come back to that 250 and we say we want to sell it. So we're going to come here and just sell a single put. And if we put this order in, now we could put it in the short put category. Let's say that we don't have it in a category, that we just put it in the account. So when this fills, if you say, oh, darn, I meant to put this in a group, we can then come down here and say, now I want to add this exit. So we look at it, we've sold this put, and now we can say we want to create a closing order that's a limit order to buy it back when it's worth 63 cents. And we're going to make that good till canceled, and that's how we'd add that. And then if we want to move it to a group, so I'm going to just add this in, and now when we come down, we can see this little chiclet that says we want to buy it back. And then we, if we're saying, well, we want to move this and have it in our group with other short puts, if in fact we have short puts, and then we can just move it to our short put group. And where are my short puts here? Don't see it. So if we want to add a new group, short puts. Okay, so we still have some things, and we could call this our cash secured short puts too. And then it's in that we've got a new category, and that's how we would add that group. So there's our cash secured short puts. And then if you want to add a column, you can add this column that says, I want to see how close I am to that 90%. So it's actually P/L, our profit and loss percentage, we can add that. And then when we come back and look, we can see, whew, we're up $2.50. We're less than 1% of the way there. All right, so let's go back and just go through a couple of other details that I'd like to cover before we wrap up. And I set you off to be able to go and practice. So one, our outlook on this is, remember, it's neutral to bullish, just as a time frame. Our time frame is typically in that 20 to 50 day range because we want to benefit from time decay. So we're selling something, and then we want to buy it back when it's worth less. And every day that we are in that trade, it becomes worth less. From a technical perspective, often we're looking for a delta of 25 to 50, which means that every time the stock goes up $1, this loses 25 to 50 cents in value. And that's exactly what we want to see happen. From a position sizing perspective, some traders will base their position size assuming that they could lose all of it. They'll also position size saying, if the stock were assigned to me, it wouldn't be too big a position in my portfolio. So some of the benefits, one is that you're generating some income. And so some people will do this as a wash, rinse, repeat. So if they sold a put on American Express and the stock continued to go up and they bought it back, when it was worth 90% less, then they might just sell another one, at maybe a higher strike as the stock continues to go up. Some investors will use this as a way to be paid to buy the stock, or in essence, to buy the stock at a lower price. I'm not saying that that's how your accountant will see it. For that, you need to talk to them, but that's how a trader might think of it. It's like, I'm being paid to buy the stock, so I'm in essence getting it for $6 less, if the stock is assigned to them. And it's often, considered to be a short to an intermediate term time frame type of trade, because you're looking at 20 to 50 days. So, but, the most you can make is what you got paid to get into the trade, is that credit that you were received. And these options, it can be assigned to you at any time. So when I was showing you that sideways range and saying, like, hey, if this came down and hit the support level and our strike is here, we could be assigned. And then you have to decide, do you want to wait in the expectation it's going to come back up, or do you want to take the loss? And the probabilities are higher that you could end up having to buy the shares at a strike that is above where it's currently trading. And the more the stock falls in value, the higher the probability that it could be assigned to you. So it's important to remember that and to look at your technical analysis and to not stick your head in the sand if the trade goes against you, but to manage it. Okay. So what are the additional considerations? Well, you've got to have enough money in the account if it gets assigned to you. So that's important. We talked about it being, if it's assigned to you. In fact, that was part of our calculation before we entered the trade. Is this in alignment with your max position size given your account size? If all of a sudden this is a big plop in the bucket and it takes up half your account. So this isn't a trading strategy that many people will use if, they have a smaller account. And then a lot of times people want to be aware of dividends or earnings coming up. Now, the benefit of earnings coming up is that volatility is higher, so you'd get a higher credit. But what if the stock gaps against you and gaps down? Then you could be in a world of hurt. And that has happened. And so when volatility is high, many times people will say, ooh, let's look to sell something because your premiums will be higher. So that's something that people will take into consideration also. Okay. When to get out? Well, we put in an exit and said, hey, when we've got 90% of our profit, others will say 90%. I don't want to be in it that long. Like if I've got 75 to 80%, I'm a happy camper and I want to exit. And you know, this is your trading plan. You can make it anything you want. Others will say, hey, when we get in that 4 to 10 days prior to expiration, you know, what if some big news came out on this company? I don't want to take the risk and not have time to recover. So I'm going to exit. That's going to be part of my trading plan. Or if it breaks a major support level. So you might be willing to wait it out, but if it breaks a major support level, even though you're taking a loss, you want to avoid taking a bigger loss. And if you want to own the stock, you may say, you know what, I'm not going to do anything. Even if the stock is falling, I wouldn't mind owning it, so I'm okay with that. You know, and so these are just some example, you know, considerations. But you should have a plan that includes when you're getting out. So we've covered, you know, what a cash secured put is. We've looked at some of the numbers, some of the things that you want to consider. We've looked at some of the basics with respect to when might you get in, when might you choose to get out, and we've placed an example trade, and then we've looked at some other examples that if you want to practice, you could go and practice. Now, I know that we have some new people here today, so I just wanted to point out a couple of things. One, if you haven't hit the subscribe button in the bottom right corner, you're going to want to do that. And why do you want to do that? Well, if we come out to Trader Talks, by hitting subscribe, it subscribes you to the Trader Talks from Schwab Coaching. When you first come into this page, what it'll show you is the webcast that is currently being taught. If you come over to playlists, you know, and you want to do some binge learning, you can come down here, and it's the second row from the bottom is the Getting Started with Options series. And so you can see we go from week 1 through week 12. And we covered 10 different trading strategies. So, you know, you could do some binge learning. I've also created a trade management mini session, say that 3 times fast, series. And if you're new to thinkorswim, there's a whole series, and these are all in turquoise, of, you know, how to customize a watch list, how to customize a chart. You know, so these are just handy dandy. They're, you know, typically from 7 to like 12 minutes long. And then I'm creating a series of trading plans. Now, I don't have the one for selling puts in here yet, but it is coming. And these are all in blue. And so this is just an additional resource that you can take advantage of. But, you know, there's all kinds of things being covered here: technical analysis, thinkorswim, and how to use it. There's a wealth of information here. The other thing you may want to check out is the webcast. So if you come here and you're seeing on-demand webcasts, and then live webcasts and virtual workshops, and then in-person events, I talked about the in-person events. So you can see here just at a glance. So September 13th, we're in Anaheim, then Miami for a 2-day event, back across the country to California. In October, we're going to be in Denver for a 2-day workshop. And then there's an event in New York, followed by one in DC. We're heading to Nashville, you know, back to Miami. There's a lot going on just prior to the end of the year. I encourage you, if you want to attend one of these, they are free. I loved attending them as a client, and I love attending them now as a coach. I got a tremendous amount out of them, but sign up soon because they are hugely popular. And then if you want to see what is coming up, you know, here's the rest of the day. So here is today. We're getting started with options. Up next, trading with flag patterns. So that is my cue to set you loose to go and catch what Ben has to offer. He's a great guy and an awesome coach. I think you'll find it really informative. So guys, thanks so much for joining me today. Appreciate you being here. Don't forget to follow us in the land of X Barb Armstrong CS, and we'll see you there. Take care, everyone. Thanks to Scott for all his help in the chat, and to the guys behind the scenes for keeping me in line. Bye for now.